I want to show you a number, 90%. Unfortunately, that is the number of people who fail as traders when they first start. It's quite a crazy number. I've mentioned it in previous videos. I guess what's more troubling is I don't think they're gamblers. I think they're normal people who have gone out and tried to learn to trade. I was one of them for a while. So basically, there's key fundamental issues which are missing when people begin to learn to trade. Back in 2020, I was an investor, but I was also a company owner. I had a good company. I actually built my company from a tiny 2,000 pot pension to a £1.4 million turnover company with 30 employees at its peak. And during that time, I began to invest. All right, so my investments during that period in 2020 to 2021 went up a huge amount. But then in 2022, they crashed down, and rather than get upset about it, I basically thought, wow, there's an opportunity here I need to learn, So I began to learn to trade, and I felt if an opportunity like that came back again, I would be ready to sell. I would understand, And so I spend a lot of money on courses, on indicators, on YouTube learning, and I'm the kind of person who, when I start something, I get heavily involved, But I ended up just like the other 90%. I was losing money. I lost a lot of money in the early days of my trading. So anyway, that changed. I think it changed for a number of reasons. One, I'm persistent. I tend not to give up. But I eventually found my own way, and it's the fundamental reason why traders fail. I'm going to outline in this next video, and then I'm going to go on to try and describe as best I can what I did different and it's made me successful. So stay with me, because perhaps this video is going to be a wee bit longer than my typical video is, because I want to take you through all the stages of kind of what I've learned and then what I've done to address them. Alright, so let's talk about initially why traders might fail. And I think there's the obvious answer. There's things like being over leveraged, there's things like emotional trading, FOMOing, chasing trades, there's things like just maybe not having a stop loss. But in essence, I believe these are not necessarily feelings, but they're symptoms. Alright, they're not the underlying cause. The underlying cause, in my opinion, and again I'll address that shortly, is this just complete lack of framework, a complete lack of structure, a complete lack of methodology on the approach to trading. Because with trading, arguably you are making bets on whether price goes up or down, but they can be calculated and they can be controlled, and so you're not necessarily gambling. You can have probabilities which are incredibly high before you take a position, and they're based on the manner in which you approach the market as a whole. Alright, so let's address what I consider to be kind of the first failing, and that is understanding risk. And it's the very first thing I teach to my students, is understanding risk. And let's talk about leverage. Leverage, for those who don't understand, is when you trade perpetual futures contracts and an ability to go short and long and in essence make money in both ways. You end up on what is called a futures account, and you can use a tool called leverage. Now that in essence just allows you to trade with more money than you own. Sounds a bit crazy, right? But that happens to be the case. And people have this assumption, if you trade 100x, which is incredibly high leverage, that means you can potentially trade with 100 times more than you own. And maybe 10x, you would always assume that 100x is bad and 10x is not so bad, right? That's safe. But it's not the case, because I could trade 100x and add only 1% of my margin, available margin, and that is essence the same. It's a trade which would never be liquidated. And somebody who's not really thought about it could trade 10x, and they could then have all their money in, and that puts their liquidation price only 10% away. So it's the same, it's just the underlying calculation's never been made. And so there's no real understanding of risk, because I trade 100x, but I only trade 1% of my margin. It's just a nice simple calculation for me. And so I just use it out of habit. But in essence, I'm just trading spot. But people say, oh, you must be crazy in risk. No, I'm not. I completely understand risk. And I've developed a system which I almost never take big losses. If everyone will take losses in trading, but they're never big. And so the first and most fundamental step is to fully understand risk and to fully understand, how much you're allocating in any one trade. I guess the other kind of underlying thing there is dealing with greed, and leverage allows people to be greedy in a trade, So if we stick with this idea of leverage, it's very, very easy to get yourself in a way. Perhaps you made a number of wins and you can start to allocate more and more and more leverage or more margin to each trade, and eventually you can undo months and months of good work with one bad trade. And again, it just harks back to this lack of, framework, because the system should determine what you do before you even think about trading. So my rule is, and I have 3 tiers, I would never ever go above 2%. Now that doesn't matter how good the probability is. It's never more than 2% of my available margin. That's my risk framework, and that's what I apply to every trade. Now, I just have a long-term mindset, so it's not necessarily a greedy mindset, but it's a mindset that recognises compound growth. So I started with 5,000 in my trading account, and if I had this figure in my head, if I can manage to make 10% per month, each month, I know that in 5 years I'll have 1.9 million, as long as I don't spend my money. I understand compound growth and I understand the long game. All right, and that is, again, it's this idea with trading that people perhaps misunderstand. First, they don't have a framework. 2, they don't understand risk. And 3, they potentially get greedy. That's the first thing I wanted to talk about. Now, the second point is really understanding structure. So I'm going to dive onto the charts for this section and we can talk about it on the charts. So here we are looking at the charts. Let's put on Bitcoin, because I like to trade Bitcoin, and let's clean this all off. So basically, when people look at the charts, and even when they buy a course, the course will often tell them about the individual elements of what they're looking at, the candles, for example, the red and the green. It might help them understand trend. It'll give them some strategies, but strategies won't make you a good trader. I used to be an incredible analyst, but a terrible trader. I would give everybody else the signals, but somehow I was not able to execute the trade. Go figure. So now I have a way that is not unique to me, but it is a way that I like to look at price, which tells a story and helps me make some kind of understanding about what's going on. And it's incredibly simple. So let's use a higher term time frame like the weekly. And what all I do is I look for the points where price goes up and stops and then comes back down and stops. So when it goes up and stops, that's resistance. When it comes back down and stops, that is support. And I draw horizontal lines. This is like the most basic technical analysis you can ever apply to a chart. So if we'll draw a line there, because you can see the price stopped here for a long time, so that was resistance. And then it moved up and it stopped here. And then it moved up again and it stopped there. Okay. So these are, we know from the way price behaved, as resistance. Now if we kind of followed this price up and came back down, we would see it stop there. So there's support. And we can see kind of went up there, so we can draw another line there. And it came back down and found support here, so we can draw another line there. And then again there. Okay. And what we'll do is we'll build up a picture about where the real important price points are over time, And so this is telling me is previous points in time where the Bitcoin price was held up, for example here. But you notice back here, when price fell through on the way back up, it was stuck. That just happened to be exactly the same point. So you can see that just by drawing these horizontal lines, we're already able to kind of find important points going into the future. Now I see another one here. Had I drawn the support there, that would have also given me the resistance. So note how the 2 points of price action, which are historical, this and this, captured perfectly the range That was April 2025 and that was November 2025. So 6-7 months later, we're capturing this same range. Alright, so this is just the simplest way to look at it. Now I want to use a chap called Elliott Wave, who I think he was in the 1930s, and he understood that price moves through human psychology, and so he developed this kind of technical analysis, or this theoretical framework which looked at price action, and it said if it moves up in 5 waves or down in 5 waves, these are what are called impulsive moves, and then they are typically followed by what are called corrective moves, which would be 3-wave patterns. So we're looking for 5 waves followed by 3 waves. Now these can be both to the upside or the downside, it doesn't matter, but it's telling you, is the price action impulsive or is it corrective? So now let's just zoom out a little bit and let's take the all-time high for Bitcoin here, and notice how the price moved down hard here and then did a correction and then moved down hard and then did. So what I would argue is this is an impulsive move, this is a corrective move. Impulsive move, corrective move. And so I'm able to determine that Bitcoin is, since its all-time high, in a strong impulsive downtrend, because we're seeing impulsive waves. Now counting the waves themselves can be quite hard, but we don't really need to be able to count them that accurately. We just need to understand an impulsive or trending move, which can be to the upside or the downside, or a corrective one. Alright, and so you will often find in price there are kind of 3 distinct waves. You know, for example, we can get out my Fibonacci tools here, and I could argue that is a 3-wave move, 1, 2, 3, and the fact it finished and fell over kind of confirms that, you know. Now I don't want to spend this entire video going over deep technical analysis. I just want to point out how I'm looking at price and how the structure tells me a story, and in essence gives me what you would regard as higher probability trades going forward. And I use the horizontals, I use the Fib price structure, and then the final thing is I use Fibonacci tools just to get targets. So at the moment we can see that Bitcoin is pulling back here, and so I can look for what's called support. We already discussed that, horizontal support, just by running a fib from the top to the bottom. And you know, this would be, for example, this 786 is exactly on one of the green lines we drew, and it just so happens it's this first Fibonacci support. So now I have 2 things. I've got my own structure which I just drew blindly, then I pulled a fib. So that's 2 separate things which are telling me this is a potential area where I can make a buy, for example, or go long, because we would expect price to bounce off there because it's got stuck under there for quite a long time before it broke out. So if it comes back, chances are it's going to bounce there. So it's that very, very simple technical analysis. If it's brought with it, this foundational structure can help me make very simple decisions and have a point where if I'm wrong, I can get out without a big loss. And so if I, for example, in this example, 78,500, I go long there. Let's say I decide to trade on the 1 hour time frame. If the candle closes below there, on a 1 hour candle, then I just close my trade. No questions asked. I don't think I'm going to go back in, it might bounce later. No, I just close my trade because that's my plan, and the plan was set before I started. And this is bringing together this idea of a structure and a foundation. 1, I understand my risk. 2, I have very, very simple TA, which has levels which, if they're invalidated, I just close my trade. That's it. And so it's really the discipline in that execution, this decision point, which is already made before I start, which makes me profitable over time. Not my technical analysis, not my fancy indicators. But now let's talk about indicators, because I just mentioned them in passing there. Indicators are a valid source of information, but they're not the underpinning element of my trade, which I just discussed. What indicators do are bring me extra confluence, or bring me confidence in the probability for my setup. So when we're making a trade, all we're doing is betting on whether the price is going to go up or whether it's going to go down. It's 50-50. It's not rocket science here. All I need to do is guess which way price is going to go. So I've gone through the initial things I do, looking at structure and understanding the underlying bias for direction. I can then draw my levels, and then I can look at 3 other things which will increase further whether my trade is likely to go the way I want it to go, and then therefore give me that extra confidence. So there's 3 indicators I use, and they're all readily available to anybody. There's the first one's called the RSI. Now this is a fancy one. You can get a plain RSI, it doesn't really matter. And this is really just looking at, in a very basic manner, whether the price is overbought or oversold. What I use it for is actually finding things which are called divergences. Now, the scope of this video is not to discuss divergences. I actually have videos on divergences in my YouTube channel, so just dig through and I'll talk just about divergences. But they're just another way to kind of get confluence. We'll add on the BBWP, which discusses volatility. Now, again, this doesn't give me price direction, but I'll briefly discuss that. What we're looking at here is volatility in action, if you like. So when we see volatility down here, it's given me the idea that a more explosive or impulsive move might begin. All right, so let's look. The weeklies are probably a good time frame to get, because this happens less frequently, and so the moves are probably more powerful. So what we have here is, if you see this expansion here, so volatility is low, we get the blue bar telling us it's ready to expand. When we see expansion, the move in this case was a very explosive move to the downside. You can see the price really dropped off very, very hard. So as volatility expanded, price dumped, and it was the same the time before on the weekly. All right. Now, what would give me a real bias on direction is looking at the third indicator I use, which is called stochastic. Now, again, I've got a fancy stochastic, but you can get a free one. It doesn't make any difference. So what we do at the point of expansion is check the direction of the stochastic. Now, this one was tricky to see, but it's down at that moment. Now, it doesn't matter if it's extremes or not. As long you check for expansion, you look at the stochastic, in whichever direction it's going on is giving you that overriding bias, if you like. All right. So that's looking at what we would call momentum. Where is the momentum? Is it about to get really kind of explosive, or is it going to be sideways and choppy, basically? So altogether, those 3 indicators simply add confidence or confluence to a decision which I've already kind of got, or an edge which I'm looking for. You know, so this is the underlying technical analysis aspect. Now let me bring you back to my early days of trading. I had all this knowledge. I had spent infinite amount of time, and I'm talking about the technical analysis here, but it wasn't in a framework. It didn't have like a list of rules which I followed. I was entering trades based on what I saw. But as the trade developed, rather than leave it alone and stick to a solid plan, which I never had, I just had an entry, and maybe I'll take profit up here. In price, when you're trading, it does not move linearly. It moves all over the place, and that's by design. What you're fundamentally looking at are more or less large corporations who are incredibly adept traders trying to outposition each other. And so it ends up outpositioning 90% of retail traders. The only way you can win against large corporations is having your plan and sticking to it, thinking about it on an absolutely basic level. Price can go up, it can go down. Here's my entry, here's my invalidation, here's my take profit, and just let it run. So now the trade's running. I have confidence in allowing it to do that because I set the framework. The framework for my course is what I call the 10 commandments. Now, I'm not going to bore you with the 10 commandments, but it's just a list of rules which I just stick to, absolutely, and without any kind of like deviation whatsoever, you know. So it allows me now, because I've set my rules, I've set my system, you know, it is so systematic now. Trading, it can be actually quite boring, and this is the last kind of psychological element which really kind of ruins your retail traders, and it is the psychology. It's this fear, this innate caveman brain we have that, you know, makes us protect things and make silly decisions. And it's not always about losses. For example, we might be in the best position in the world, and I was terrible for this. I would oftentimes, it was when I think back, it was so bad. And I'm telling you, there'll be traders out here who will relate to this. I would have an entry. It would then, price would move against me. Now that without taking kind of profit, I would just wait for it to come lower and buy a bit more because I hadn't lost enough money already. So then I'd be losing money, and then I'd buy more, and then I'd lose even more money. I'd buy more, and eventually the price would bounce. And so what would happen is I would be grateful that the price came back to my break even again, and then I would stop the trade. And I'm laughing because it seems so completely stupid now based on the way I trade now. But that is, I'm sure there will be traders out there who can relate to that. It's such a banana system, and yet I was like, oh, it's fine, I'm getting this cheaper, I'm fine, I'm getting it cheaper. And then you would lose so much money, you would panic, and then I would just hold, and then got back to break even. That was a great trade. And then what tends to happen is the trade runs away in the direction you wanted to, but you're just taking profit anyway, so you were back to square one and guessing. And this is the weird psychology of trading. That's one of the examples I reflect on a lot because I used to do it all the time. And just taking profit too quick. Not letting your winners run, not having a set and measured target, and that's where the fibs come in. So I always have a technical target. It's not just an arbitrary take profit here, take profit there, take 50% once I've made X amount. That's not how I trade now. It's based on actual technical targets, and they're the horizontals more often than not, and what the Fibonacci extension tool can provide, and it's incredibly useful and incredibly accurate over time. So this real psychology in trading is removed by my rules, and that is a key element. So let me just summarise and bring you back to that 90%. Those 90% of traders who fail don't fail because of lack of ability or lack of, understanding technical analysis or intelligence. They just lack a structure. The 10% who make it find that, and they're not necessarily better. They just decide they need a set of rules and they apply them consistently. And if you look back at the famous traders, they're going to tell a similar story, and a story that's not often told, and a concept that's never actually brought to you when you buy a course. I have bought several courses and spent a lot of money on them, and not a single course taught me a set of rules, a system. It taught me strategies, it taught me how to read the charts, but it did not tell me how to trade. It did not make me a trader. It made me a good analyst, but a terrible trader at first. And so now, with a simple system and a simple set of rules, we can compound our wealth over time, systematically, for only 1 or 2 hours per day.